in talking about acquiring hotels in that business, what are some like the key metrics that you pull into your own database, and like when you're underwriting the actual deals themselves, what's kind of deal breakers for you that will tell you if an asset's going to be in your profile or if it's completely going to be outside of your zone?
Yeah, I mean, we tend to be more in the branded segment. So I think high level, we look at the basic components, forget KPIs, more age, brand, things like that, because just, we're concerned about basis creep, more or less like CapEx that we need to add into the property. So that's really important for us. But apart from that, I mean, we look at the key performance indicators in hotels, which is revenue per available room, how that's shifted over the years, especially in periods of like turmoil, like COVID. So how did it, dive down? How did it recover? Obviously, we look at positioning of the RevPAR as it is today versus the comp set to see if there's opportunity. We look deep into the P&L in terms of profit margin to see if there's an ability for us to enhance that apart from revenue. Because we're not in the business of buying stable assets as is. We want to be able to perform on them and improve on them, unless the basis is really strong. So those are things that we really key into. And then I think we look at supply, what's coming in, what could come in, what impact would that have. We look at demand generators and more so like mix of sales and mix of demand being diverse, like we talked about earlier. So are you getting one segment or are you getting five, right? And so if one dropped off, can you make it up with the others? We dive deep into revenue management in terms of like how they're yielding today and what we think the opportunities are, just because a lot of our team has that background. And then we really deep dive into like, what is it going to cost to do the renovation? What is necessary beyond the renovation and deferred maintenance? All those things. Again, I think for us, basis is always key because operations and profitability can change just given macro factors that are oftentimes out of our control. But the basis and what you buy is always something that you will control and will need to have confidence in to weather the storm. So that's super critical for us in terms of how we evaluate things. But in the context of everything that we look at, how is that basis relative to the opportunity? And that's kind of what we're trying to get to in a nutshell.
And so from a revenue management perspective as well, when you're looking at the business opportunities, you mentioned when new supply comes into the market. How do you predict that? How do you handle it? How do you forecast, reforecast? Because some of this may be controllable, some of it may be uncontrollable.
Yeah.
How does that factor into your decision making?
Yeah, I think part of it's, we look at what obviously is signed or coming to the market. We deep dive into if it's signed, has it been actively focused on? And if it's not, then are people having a tough time getting something new built? Obviously, I always say that, if someone's willing to build something new, you would think that they have confidence that there's going to be demand to be able to support it. Because when you're building new, you need to perform at high expectations to make it work, right? Just given your basis is going to be much higher. So, you would expect that the market conditions of that specific market are strong or growing. That's not always the case. Sometimes people will build new and they know it'll do well because it's new. And there's some truth to that too, right? And you can absorb from the other properties. But for us, it's more about, okay, if it's not already signed, what brands are available, what could come, and then are we in markets that have high barriers to entry? Is land not available? Is land expensive? So those are ways to protect against potential, new supply coming in, because one, there's no availability unless something has to be torn down and redone. And in that case, you're maybe losing supply but then gaining it back. So you have to deal with more competitive supply, but it's not at least net new supply. So those are things that we really factor into in terms of like, again, the toughness of the market to enter and market hurdles. Those are very critical for us to kind of evaluate.